Okay, if I can get our panel for the next session to come up to the stage, please. So we've seen, we've talked about the pretty ordinary or poor returns from equities, from bonds. We've had a lot of volatility in markets. One thing clients then obviously asking is, where do I get income? That's what our next session is going to talk about. The moderator for this section is Daniel Stojanovski. Daniel is Head of Research with Centrepoint Alliance. Please welcome Daniel to the stage and the panel. Thanks.
So in today's panel, what we really wanted to discuss here is where do we go for income? And it's an interesting question and something that's, I guess, we're spoiled a lot more for choice given where interest rates have been at and where they're going. And essentially moving up the risk spectrum, you've got anything from cash all the way up the risk spectrum that is providing that yield. And I guess that question that is being asked by advisors and the like is, where do we go and in receiving that income? And essentially looking at, well, are we taking on a lot more risk for that income, or are we just remaining and lowering our risk budgets? And what we have here is Charles from Clearbridge, Adam from PIMCO, and Mike from Schroder's to discuss. And Mike, will get you to start first.
Sure, thank you, and thanks everyone. As mentioned, I'm at Schroder's Investment Management. I run a couple of portfolios, but one of them is our Absolute Return Income Fund, which is predominantly looking to access streams of income globally, so using credit rates and currency. And I think to your opening remarks, clearly at the moment we've had a reset in base rates and reset in credit spreads, and as a result, the ability to deliver income has improved significantly, particularly versus a year ago where cash rates arguably were close to zero, credit spreads were very tight. So there's a lot more opportunity, but I think given the current market environment, what we've seen overnight, the US Treasury front-end curve, massive moves, some challenges around bank solvency, I think it's going to be very important to be active moving forward and searching for income to make sure that, particularly in defensive portfolios, that you're not exposing yourself to excessive amounts of risk as you try and basically pick up that income stream. So I think once again, it's never a dull moment, but I think at the moment, accessing income but also preserving capital is going to be really important moving forward.
Thank you. Adam?
So I'm Adam from PIMCO. So we're predominantly a global bond manager, fixed income manager. It's great to be able to come and talk about income in bonds again. Didn't get many invites for a couple of years, so it's nice to be sitting back on the podium. No, look, I think the key points for me, and we'll talk a lot about it in the Q&A, I think, but just given the magnitude of valuation shifts over 2022, when we're thinking about income, I think key point for me is it just demands consideration for rebalancing income streams for the next couple of years. Expected returns from bonds and equities after last year, aren't miles apart in in our models. When you have a look at core bonds, you're getting you compare income streams to riskier alternatives, and they're pretty similar. Historically, do very well in recessionary environments, and an asset class with daily liquidity. So haven't had that opportunity for a long time. We've had really dramatic changes in relative valuations across asset classes. So I think for 2023, it's not the year for inertia. I think investors have been underweight, structurally underweight an asset class for a long period, and 23 is presenting some really attractive opportunities across that spectrum, which I'm sure we'll get into over the next 30 minutes or so.
And lots of dinner parties you'll be invited
That's
to.
Right.
Thank you. It's definitely not the year for inertia. I would agree with that statement. So my name is Charles Hamieh, and I see quite a few familiar faces in the audience. So thank you for all the support. So I run the Clearbridge Global Listed Infrastructure Income Fund, amongst other infrastructure strategies. So we get our income by investing in infrastructure and utility assets around the world. And it's quite unique infrastructure as an asset class, a listed asset class, in its ability to deliver not only a very high dividend, but a dividend which, through most cycles, even currently with very high inflation, a dividend which can grow well above inflation. And that's a function of the pricing mechanism, being regulated, or concession agreements, the market structure, so the monopoly or oligopoly market structure, which lends itself to regulation. We're quite fortunate now as well that even though they're essential services, they're right at the forefront of things like decarbonisation, the onshoring of supply chains, digital communications, and a few other topics we'll talk about today. But finally, they're essential services. So whether we have a hard landing, a soft landing, or anything in between, these are assets which will get used. Water assets, gas assets, electricity assets. So there's a high degree of predictable outcome. And by virtue of that, their ability through a cycle to pay a very high dividend, which grows well above inflation, is very unique. And when you have inflation, which is passed through as part of regulation or concession agreements, interest rates, which is also passed through, so you and I, as user of the asset, bear that risk. Again, the asset class is quite unique in its ability to provide that total return, but the topic of today, a high income, which grows well above inflation.
Great, thanks, gents. I guess I'll be a little bit cheeky in terms of the first question, in terms of just starting, because it is an important one. Are investors rewarded, I guess, in the short run, looking at 1 year, from a fee perspective, from a budget, sort of a risk budget sort of perspective, in being in sort of asset classes like cash, for example, or a term deposit versus other assets? Why is it so important to consider, I guess, from an income perspective, other areas there where risk budgets, fees, and like that are so important?
Yeah, look, I think in terms of, clearly cash plays an important part in client portfolios. Clearly it's liquid, capital stable, and depending on what sort of that liquidity needs to be used for, it's really important to have that. The question ultimately comes down to a portfolio construction question in terms of how much cash am I going to hold, but importantly, what are the other assets that I actually may want to hold through different parts of the cycle. So I think what we can see from time to time, particularly as term deposits improve, supposedly on the outright yield, there's a temptation to pivot into that. But when you step back and look globally across developed market, emerging markets, investment grade, high yield, securitized markets, there are a lot of opportunities out there to earn yield that actually will deliver longer term income. Particularly in the case of term deposits, they're pretty slow to reset up. And also too, for example, you're tying up sort of from a liquidity perspective. So at the moment, if you think that, we've seen global high yield trade at maybe 9%, you're starting to see emerging market bonds look relatively attractive. If you've got all your capital tied up in a term deposit, your choice is either to avoid and have the opportunity cost, you can't actually pivot your asset allocation choice, or potentially having to basically break the term deposit and whether or not you lose the capital there. So from a portfolio construction position, having liquid cash, I think makes a lot of sense, particularly in the current environment that we're going through. Term deposits play a role, but I think ignoring all the other global portfolio opportunities, I think is ultimately sort of to the detriment over longer term timeframes.
I think also it's always a question we often get, should I own cash or should I own bonds? Should I own cash or should I own something else? And it's really the wrong question. In any sort of portfolio construction, particularly income, you have to think of the whole portfolio. You shouldn't just own one or the other. It's more about what are the objectives of the income portfolio that you're managing, and what's the most optimal way to construct a set of alternatives in that portfolio. Not really a switch of on and off, but how much of each. And you just have to look at the different benefits from a different income stream. So, I can talk to bonds, and Charles will talk to infrastructure, which I'm sure is a big one's inflation. But from bonds compared to TDs, obviously a big thing is how they perform in really challenging economic environments like recessions. So if you have a view, and it's not a heroic call, it's pretty much a consensus call that over the next 1 to 2 years we're going to be in a recession or near recession, just given the degree of monetary policy tightening that's gone through. Bonds typically do very well in that environment. That means if you're sitting in cash, you just incrementally get less return as cash rates go down. If you're sitting in bonds, you get a capital appreciation as well as the income that you were investing in at the start. Plus, you get the daily liquidity in a core bond fund. So that liquidity alternative to a TD, the capital appreciation in really difficult times, some of the core strengths. But always trying to get away from that bonds or cash question. It's sort of how much do you need of each, depending on your sort of liquidity and income requirements.
I can't ignore inflation as well. Cash rates maybe have peaked, may start to go down. Inflation is going to be structurally stubborn. So the ability to protect yourself against that inflation, to preserve, your real income, is probably as important at this point in the cycle as just being in cash. Certainly as part of a diversified portfolio. And again, that's the nature of the asset class, and probably something you can achieve as well in other asset classes as well, but probably not as unique as you can in infrastructure.
No, thank you. I think this is more of a question for Adam in terms of, in the last couple of years, there's been a lot more of a move to high yielding type securities, so high yield, looking at private debt and the like. Concerns around, I guess, that part of the market, essentially, that chase for yield has been there. Any sort of concerns with sort of holding things like that, given where, from a market environment, where we're at right now?
It really depends on the asset class. So private in particular, no, I think there's some level of concern. Really depends what you're invested in. At PIMCO we manage anything from sort of cash to short-term treasuries out to private lock-up vehicles, high yield that are targeting double-digit returns. So kind of have the whole spectrum, I think. But specifically, just looking at, we have come through a period of very low interest rates that makes people stretch for returns and stretch for income. I think the most important thing, whether you're looking at a private alternative now, or which there's nothing wrong with that, or you're currently holding a private alternative, we've had a huge revaluation in public markets. So if you're looking at investing in a private vehicle that might be real estate debt or a real estate, or you're holding one, if you're not buying it at least 10% lower than it was last year, I'd be asking questions. So it's more around, yes, less volatility because you're not getting the daily marks, but make sure the marks that you're entering in or you're holding at the moment are reflective of where the asset class is trading.
And I think just going on about that, essentially asset class valuations have been quite stretched. Unless we arrive on soft landing island, for example, what are people's thoughts in terms of the asset class space, Mike?
In terms of private assets?
Or in general?
Yeah, in general. I think clearly what's happening at the moment, we've sort of seen a lot of volatility most recently, is that we're moving through this transition phase where we've had excessively loose monetary policy settings, and clearly central banks globally ratcheting rates up significantly at a very quick pace, one of the quickest paces in history, and something's bound to break. And we've just seen that effectively overnight with Silicon Valley Bank and now potentially some talk about Credit Suisse. But I think what has definitely changed is that clearly there's more risk premia in the market, so that's a positive. But our view currently is that, well, as we move through this adjustment phase, you expect volatility and variability, and as a result, you want to be careful in terms of how your portfolio is constructed. So we prefer more liquid assets, higher quality, something that's going to give you some good carry, and wait for valuations to improve to reflect the sort of the current environment. And I think as we move through this next phase, the question around inflation is still very much alive and well. The expectations now that the market, the Fed's going to pause or even pivot and cut, I think just creates volatility, and importantly creates the ability for active managers to sort of add value as we move through this period. So when we have a look across the spectrum, we still think high yield is expensive. Private assets have a place, but I think you need to make sure that you understand exactly how the characteristics, both in terms of illiquidity, but also to the underlying asset prices. Just because there's no data points doesn't mean valuations don't change. And then we sort of quite like investment grade credit, but still high quality carry with liquid assets, we think at the moment is really important. And to the point before, bonds have re-emerged and duration-based assets have re-emerged after sort of a pretty tumultuous 2022. They've gone from boring to terrifying to now quite exciting in some ways, if I may say that bonds are exciting. Please don't quote me if there's any journos out. But I think quite clearly what it means is that we've had a massive shift in the landscape. Base rates have increased, credit risk premium have rebased, and there's lots of opportunity. But once again, I think we're not through this cycle, we're not through this adjustment phase, so hence we want to be active, we want to be cautious in terms of how much risk we're taking, and wait, I think, for extended valuations, particularly in high yield, before you start jumping into those assets and setting yourself up for that next run.
And Charles, thoughts around private assets, I guess, looking at it from a perspective of an infrastructure perspective, you've had industry super funds, for example, in that very, private assets sort of space. Is there a role or thoughts around that from I guess liquid?
There is a role for private assets, but I'll give you some context. So prior to joining the listed dark side, I ran a very large unlisted direct fund, and when I was buying and selling direct assets, the valuation multiples between the direct assets and the listed transaction trading multiples were very similar. and there wasn't much difference. Roll forward 15 years, or 13 years, sorry, some of the transaction multiples we see in unlisted or direct are 30, 40% higher than comparable trading multiples in listed. And that's just not sustainable. And when you see these transaction multiples, these differences, you know, three things happen. One is a direct investor will just buy a listed company, Sydney Airports, Spark Infrastructure, AusNet, ALX. We benefit as listed investors. You know, two is listed companies are just selling non-core parts of their assets, their businesses, saying, you know, if you want to pay this, you can have it. And they recycle that capital into their own businesses, strengthens the dividend growth, makes their businesses look so much better. But finally, it's quite unique right at this point of the cycle, and I think it's not only infrastructure, I suspect it's property and most other asset classes, because you haven't seen the revaluation cycle down in unlisted or direct. Right now, there's quite a unique opportunity. If your time horizon is more than a week and you're quite ambivalent to how you hold the asset, then buying a listed liquid vehicle, the same asset, quite often the same regulator, quite often very similar capital structures, by virtue of your lower entry price, if you were to buy and hold, then you should see a higher return. And that's where we think we are in the listed private debate. And I think it's quite not only unique to infrastructure, I think it's across most other asset classes.
With Australian rates being where they are, and obviously lower than globally, is there more of a theme, and I guess just an open question, is there more of a theme of going global for income at this current stage?
Well, a couple of things. So it depends if you want the currency risk. You know, if you compare a bond in Australia that's trading at 4% versus a bond in US dollars trading at 5%. If you're happy to take US dollar risk and buy US dollar securities, and you can earn the 5% income, if you hedge that currency back to Aussie, you're getting 4%. So I think the global argument is less about relative interest rates. There's no free lunch in financial markets, and the only way to get their interest rate is take their currency risk. If you don't want it and you hedge it, you get our interest rate. So the advantages of global open up an enormous universe of investment opportunities really that provide diversified portfolios, much more attractive income that you typically can't get here even if you hedge it. And so that's really the advantage of global. If you look at the size of the global fixed income market, it dwarfs equity markets. It's everything from, as I said, cash and treasuries to investment grade, high yield, emerging markets, structured, everything in between. So that you compare that relative to the sort of fixed income opportunities in the Australian universe, you just don't have that. But there's no free interest rate lunch.
Yeah, I mean, I think from a global perspective, clearly there's considerations in terms of hedge back yields, for example. But I think from our perspective, being a sort of global investment house, so to some extent talking our own book, is that we don't think it makes sense just to constrict yourself to the local market. Particularly when there's opportunities offshore that at different points in the cycle are going to be really, really important in order to deliver that income. And I think as we move forward and we get some more dispersion across central banks, that's going to sort of come to the fore as well. And also too in credit assets, if you have a look at the Australian investment grade credit market, it provides you good high quality, lower risk yield, but then that's a small segment, as mentioned, the global market. So we don't think it makes any sense to sort of cut off any sort of opportunity set in sort of public markets. But what you really need to do is have a strong framework in terms of deciding to allocate across those assets and the valuation framework. That means you're actually not buying assets purely because the yield looks high. But it's actually more from what are the valuations telling us in those markets, and how much am I getting paid for taking that risk, whether it's term risk, credit risk, subordination risk, illiquidity risk. In a situation where if you're buying assets with valuation support over longer periods of time, you're going to end up with a good result. If you're simply buying expensive assets, even if the yields look attractive, then I think you're sort of baking in some potential problems down the track.
Certainly. I mean, back to the most basic level, think about Sydney Airports when it was taken over. There's like 10 other Sydney airports around the world. Transurban, there's 20 other Transurbans. Spark Infrastructure, all slightly different and nuanced, but just being global does open up, that ability to invest in very high quality companies with strong concession agreements, strong regulation, similar characteristics, diversifies your sources of income, your sources of total return, and really does make a lot of sense, certainly in the medium to long term.
just Charles, while we're discussing, I guess, looking at, I guess the environment has structurally changed, specifically, and I know we touched about it before, but just inflation and where inflation being stickier, how you're sort of seeing that space and the role, I guess, of infrastructure and thoughts around it.
Again, I think the last mile of inflation will be very hard, and that's what our companies are telling us globally, that, you know, to get it from 5 to 4 maybe, but expectations are quite entrenched now. So that is our view, and we certainly feel that last year was a really great year for the sector because of that resilience of that pass-through mechanism and how it protected people's incomes. But we think that that thematic still has quite a way to go. And I spoke earlier about just how enshrined that pass-through is. I mean, regulation is designed to do two things. One is when you turn the lights on, down, the lights come on and stay on. And two is it's designed to provide the appropriate incentive structure to make sure that companies are incentivized to keep spending. And to do that, variables outside of their control, interest rates, inflation, the risk of those are passed on to the user of the asset. So it's really enshrined in how frameworks work. A high inflation environment doesn't benefit these businesses, but it certainly preserves their free cash flow in a much more mechanically than most other businesses.
There's been quite a bit of diversion in central bank policy, navigating that. Just wanted to get your sort of thoughts around, you know, Adam, maybe you to start this in terms of, you know, the variability of interest rates and in general, you know, policy.
I think we, last couple of 48 hours in the US with the collapse of SVB kind of sort of lends to that our expectation that we're kind of in approaching the last innings of a rate hiking cycle. Developed economies are typically highly levered. When you raise interest rates from 0 to 5% in 12 months, stuff breaks, and we're starting to see stuff break. And so in every country, when you look around, that level of interest rates where the fragile balance sheets start to break are a little different. In Australia, it's a little lower. You've seen RBA go a lot slower, slow down the pace, start later, talking about pausing when we're kind of in the mid-3s and not up around 5%. And that's because when you look at Australia, the fragile balance sheet is households. Households have, an enormous amount of debt, more than 40% more than US households compared, relative to GDP. So, when we're looking around to see just how high interest rates can go in different countries and just where they start to bite and, bring down inflation, I agree that the last mile to get inflation from 4 to 2 or 4 to 2.5 is going to be really tricky. But, we're certainly approaching interest rates where that starts to bite and starts to bring it down. And we're starting to be more concerned about banking issues and recessions and inflation, which is what we were worried about last year. But so in Australia, it's we've always said for a while that 3.5% to 4% cash rate is going to be just about as tight as Australians have seen as households. Going all the way back to 07, 08 when cash rates were up at 7, because since then households have taken on something like 25% more leverage relative to their income. The banks, obviously, through that decade of cutting, didn't pass on every cut, and so a 4% cash rate now is more like a 4.75 cash rate back then when you look at end borrowing rates. So when you put all that together, when you get up to 3.5%, 4%, it's going to be about as tight as Aussie households have seen. Doesn't mean that central bank, the RBA, can't go beyond that. It's not an electric fence. It just means the risk of things breaking if they go beyond that goes up exponentially. So we have seen a lot of variability. We think we're approaching levels now. I think that the sort of the volatility the last couple of sessions kind of lends to that expectation that we are getting to levels that are biting. We're starting to see inflation, although we've got an inflation print tonight in the US, so interest rates could jump up, reverse some of the moves in the last 24 hours. But we're in that last sort of innings where interest rates are restrictive, growth slowing, inflation's coming down. We're going through the last sort of couple of months or couple of quarters where we're flipping between sort of growth concerns, inflation concerns, and banking issue concerns. But we think we're getting to levels where that variability in interest rates, particularly on the upside, is starting to bite and be restricted.
Mike, did you want to?
Yeah, I mean, to follow on from that, I think as we move forward, clearly the reaction function of individual central banks is going to alter depending on the domestic economies. There's some clearly interrelated sort of elements to it, particularly if we do get a banking crisis. We've seen previously where we've had coordinated easings globally, but I think as we move through this next phase and central banks sort of adjust the monetary policy settings is going to be driven largely by the domestic economies. And the different challenges around inflation. I'd say Australia has probably less of an inflation problem than the US, and that's reflected largely in some of the sort of the expectations around sort of terminal rates, etc., in different countries. But I think what it does highlight is that across markets, across different global jurisdictions, there's going to be opportunities as we move into sort of less sort of synchronised sort of policy moves, if you like. And the moves we've seen overnight with the front end of the US curve rallying 100 points, that's that sort of volatility and variability. I think is going to become sort of, if anything, more the norm as the markets sort of second guess in terms of exactly where that pivot point is for central banks. Markets moving from pricing in tightenings, potentially pricing in easings. That's going to be driven by sort of more domestic issues. And also, too, clearly, you've got some challenges around systemic risk in the banking sector at the moment. But I think there's opportunities across fixed income markets globally. Whether it be dispersion across different economies and different monetary policy settings or different credit markets, etc., which I think for fixed income investors is really a great opportunity, particularly if you're focusing on managing risk. I mean, there was talk that basically hedge funds were massively short the front end of the US curve, and there was a lot of short covering. Some of that volatility and variability that markets can move very quickly, you need to be able to manage the risk across all of the components of your portfolio.
And Charles, did you want to?
I don't think I would add is, I think it's pretty clear the moment that central banks around the world think they can pause, I think they will. And the moment they think they can start cutting, I think they will. So that's probably what I would add. So I don't think that, there's going to be sort of an extended period where the central banks don't react either way. But again, I think we're closer to that inflection point than we were 3 months ago. Or than we were like last week, potentially.
Yeah, that's right.
Last night.
Mike, you mentioned this, opportunities, and maybe just getting a thought from everyone. Opportunities that you're seeing, I think, going forward in terms of from an income perspective, from what you're looking at, that is really interesting.
Yeah, I mean, at the moment, given we're in this transition phase in terms of monetary policy settings being reset, we're seeing tightening of lending standards, etc. We're still very much focused on sort of defensive liquid asset classes. Not only the return side of the equation, but also importantly the risk as we move through this next phase. And we could sort of see volatility emerging, but some markets are actually not pricing in anything like a recession or a hard landing. Global high yield, for example, the CDX was sort of mid 500s not long ago, but that's not pricing in something like a recession type risk. So we would prefer to have high quality liquid assets managing the downside risk and waiting for those markets to reprice, waiting for recession to be more heavily priced, for a jump in defaults to be heavily priced as you get it with monetary policy settings start to bite, you get a withdrawal of liquidity in the system, and you start to get that normal default cycle come through. So long way of saying we're sort of focused very much on delivering income, but not at the expense of sacrificing, introducing a whole heap of left tail risk, which I think some asset classes like high yield, for example, and sections of emerging markets are doing. So if you roll back, getting a sort of a 5% yield on Aussie investment grade credit whilst you're sort of waiting for markets to sort of move through this adjustment phase is probably not too bad for investors, particularly when you roll back a year ago, you'd be basically buying global high yield to get that. So long way of saying we're finding opportunities in terms of high quality carry, we're remaining liquid, we're adding duration and some currency to manage downside risk, but we're still very patient given we're not all the way through this adjustment phase, and we still think inflation is going to be a problem to some extent. Central banks will be hamstrung in terms of what they can do. The normal playbook of hiking till you break and then cutting given the fact we've got inflation now, I think is going to be more of a problem.
Of course. Adam, did you?
I would echo all those comments and would agree. And I think the key point is you don't have to look for anything too exciting at the moment to get income levels that are comfortably above long-term expectations of where inflation settles over or averages over the next 5 to 10 years. As Mick said, 5% for investment grade bonds. It's as I said at the start.
Exciting.
Yeah, very exciting. It's been a while since you could say there's this mythical asset class called bonds that gives you interest and income above long-term expectations where inflation's going to settle, comparable starting yields of riskier asset classes, daily liquidity, and does well in recessions. You don't have to get that exciting, really to get pretty attractive levels of income, I think, at the moment. Couldn't agree more. Where we're trying to avoid is fragile balance sheets, because as we've seen over the last 48 hours in the US, interest rates go up a lot, things break, and fragile balance sheets can't manage it. As I say, I couldn't agree more. US high yield would put in that bucket. European peripheral sovereigns I would put in that bucket. And as I said, in Australia, I would put households in that bucket. So, when you're looking at income alternatives, you don't have to get that exciting, but you want to avoid the fragile balance sheet. So if you look at Australian investors have historically got their income from things like bank stocks, paying high dividends, nicely franked, hybrids, investment property. It's just one big bet on Australia's most fragile balance sheet, which is households, either through the things they invest in, like property, or the institutions that finance them, like banks. There's many other alternatives that are, in scary states of the world that do much better, and you're avoiding that fragile balance sheet after a really significant interest rate shock.
Just before we move on, Charles, just around the opportunities, just a quick one, given that we've been talking where things are at. Duration, I guess you moved from, there's been a move from short to obviously a little bit more on the longer spectrum. Is that something you're also seeing? Obviously, it's paying a lot more yield now, but obviously it's been hurt over a longer period of time.
Yeah, well, you just think interest rate risk, obviously is a lot more attractive than it was a few years ago. But I don't think you need to get over your skis here. I think the volatility we've seen on, the favouring interest rate risk in the last 48 hours could reverse somewhat tonight when we get a US inflation print. I think we're in that last couple of months or quarters where things are quite volatile, but we're now at levels where we're seeing the restrictions of further and further interest rate rises. There's always a level of interest rates that stops spending and brings inflation down. There's always a level that breaks things, which is a little bit further. I think we're approaching those levels now. It's not that you should go out and go from zero duration to 10 years in your income portfolio, but certainly where most people start is a fairly big structural underweight to duration or core bonds. You should be moving much closer to kind of longer term structural targets at these types of levels, I think.
And Charles, opportunities that you're seeing in general, I guess, just leading on to that original question.
Yeah, thanks, Daniel. One thing I would say is that as an equity investor, duration is a wonderful thing. I mean, every investor here, the one thing that we all have is just to be a bit patient. And if your horizon, again, is a bit longer than 3 months, then your ability to take that patience and then use that duration to great advantage is always has shown to be a really powerful thing for an individual investor, a retail investor. We see a lot of opportunities now generally, and I think we're quite fortunate in the asset class because, again, an essential service. So you get really defensive characteristics. So, similar to bonds in a way, in recessions, these assets do very well. And your equity returns, as they were last year, are always protected to some extent. And through the cycle, you can earn a return which closely mirrors, asset-based growth, regulated allowed returns, etc. But for us, the bigger opportunity is that you're getting paid, 5.5% dividend, growing at almost 6% to take the asset class. And at the same time, all the structural drivers which excite us, decarbonisation, the role of the asset class in delivering on that policy goal, the fracturing of global economies I spoke about earlier, onshoring, what that means for localised infrastructure and localised, supply chains, and again, the role of the asset class to facilitate that, communications and inflation and the listed, unlisted valuation gaps. So, we're pretty excited at the moment because you have an asset class which does protect against rising inflation or even high inflation. Economies which are slowing, so the resilience should come to the fore. And at the same time, a lot of opportunities being listed investors, being active, I think is very important. And I quite often think being a private or direct investor, you overstate the importance of measurement of volatility because the passage of time has certainly shown in infrastructure that it doesn't matter where you own the asset, that your long-term return outcomes are very, very similar. But being active allows you to add another layer of return over and above being a direct investor. So yeah, I think the opportunities are quite wide at the moment in the sector. notwithstanding, there's certainly risks. I mean, I think being a listed
Hidden
equity product with beta, there's certainly risks as well, but our job is to manage that.
No, great. I just want to guys open it up to everyone, just in terms of questions that you might have for the panel.
Should be lots of questions for this session.
Adam, a question for you. I think you mentioned in there about some of the things you want to stay away from. One was European peripherals. Just curious, it's been quite a while since we heard about Grexit and so on. Are you concerned about things breaking up there again or countries getting into trouble?
No, less concern on a breakup risk, but just concern that they're the really highly levered balance sheets in Europe as the peripheral sovereigns. And so we've already seen as the central bank in Europe, the ECB, started to lift interest rates, they had to put in all these other support mechanisms to support the peripheral sovereigns who all of a sudden couldn't pay their interest bills. So less concerned about sort of existential sort of breakup of the union type of risk, but more concerned that those balance sheets that are carrying the most debt, that struggle the most under an interest rate shock, will underperform, through a rate hiking cycle. Not so much that kind of existential risk that we sort of went through in 2012.
I've got a question which sort of flows on from that, because I was actually going to ask that question, which is really the other fragile balance sheet, which is the US government, and whether in your thinking about markets and investing, you take a long-term view about the risks that are inherent in the level of debt in the US. And how that plays into your thinking.
So we used to use this term. Yes, it's a highly levered, government balance sheet, but it has so many kind of home court advantages being a reserve currency. And so we used to have this term in PIMCO, and we looked at sovereigns, and they all look pretty bad, but that one was the cleanest dirty shirt. And so it's less concern around kind of creditworthiness of the US sovereign, but or their ability to sort of meet interest payments. Certainly not concerned. We're sort of going to go through another debt ceiling debate over coming months. Might go up to the wire, but we're not worried about, not so worried about them not sort of meeting interest rate payments or struggling under higher interest rates. The other parts of the pockets of the US economy is not households. Households delivered enormously after the GFC, as you would expect, going through such an enormous shock in their housing market. Quite different to us that have kind of continued to leverage. Households there have deleveraged, so it's not the sovereign we're too concerned about. It's not the households we're particularly concerned about or property. It's more, very highly levered corporates, as Mick was saying before, would be the ones that we're more concerned about in the US rather than a sovereign issue.
Other questions? Because I have a question for Charles, which is that as infrastructure becomes a more widely recognised and adopted asset class in its own right, I mean, just as the fixed interest markets are clearly segmented into high yield and duration and so on and so forth, do you see enough opportunities in listed infrastructure for it to start being segmented in an investable way into more or less secure, more or less high-yielding investment types?
No, not at this stage. I don't. I think that you have a very large universe with a very large market cap of almost $2 trillion. But, there is sort of global thematics, there is more regional thematics that sort of influence or ebb and flow how the sector performs. Our view has been for some time, it's not necessarily how many stocks you own or how to sort of break it down regionally or sector-wise. It's just getting the position sizing right. And I think increasingly, for us, it's probably a bit more important than being, much more high conviction or thinking a bit medium-term or long-term in terms of setting up specific sector funds or geographic funds. Certainly the next iteration, and we're seeing it now, will be more ESG-specific funds. I said earlier that the sector is really right at the forefront as it relates to ESG. All the CapEx required, whether it be transmission, electric vehicles, changing the way we move around society, all that's being done by infrastructure companies. In fact, to put it another way, decarbonisation is not possible if it's not for the companies that we invest in shouldering the burden of that capex. And so certainly some companies are greener than others, and we're seeing that now in sort of the next wave of products, companies that can decarbonise a bit quicker, carbon footprint's a bit lower, capex a bit more linked to some of those decarbonisation thematics. And that's an important driver going forward, certainly.
I was just going to ask, with everything going on, do you think the Fed's going to change their balance sheet program that's going on at the moment, their quantitative tightening?
So certainly as we're getting towards, as I said, the last kind of innings of the tightening cycle, those things start to come to the fore. We went through a period where I think economists were tripping over themselves trying to forecast the highest level of interest rates that they could go to, and we're kind of reversing that at the moment. I think I even saw one of the banks forecasting a Fed will cut next month, which we're not expecting at all. But we're certainly getting to the point where all these things can be tweaked if we're going through a serious bout of financial stress. So a way a way the central bank would typically look at it is how tight are financial conditions. If banks are struggling to fund themselves, they're certainly not going to over tighten monetary policy. So I think I'm not so sort of concerned about quantitative tightening. I think that'll probably keep running in the background unless they're really concerned about something. But we certainly could go through a period where they pause hiking interest rates until things settle down. I think that's certainly on the table, but less concerned around balance sheet dynamics at the moment.
Yeah, I mean, I think the sort of the overall picture is that the Fed's trying to slow the economy. They're trying to create some demand destruction, weaken the labour market, and it's got several tools available. And I think we're at that stage there where they're having to tweak them. And the challenge is you've got lags between sort of the different policy responses as well. So I'd probably expect some more volatility coming through. But once again, as we continue to tighten until something breaks, then arguably they ease off, try and patch up that little problem. But they need to solve the inflation problem. The way they do that is slow the economy. The labour market cracks. It's uncomfortable, but once we know if inflation gets embedded or more embedded in the economy, that you have a lot more problems and you potentially double-dip recessions like we had in the 70s. So I think we're a long way through, but I think if the Fed doesn't stay the course because of a potential banking crisis, then I think we've got a whole other range of problems coming down the pipe.
There's no other questions. I guess we'll just sum up in terms of takeaways. So looking at portfolios, I think it's just important, having a diversified level of income managers or income in general coming from different parts of the portfolio is key, and how much risk you're willing to take. I think that's going to be a really important takeaway. But thank you, and thanks everyone.
Thanks, panel.